Hey, my name is John Stevenson. Welcome to the Guaranteed Retirement Guys show. Today we're going to be talking about the best annuities for retirees who are looking for security but also growth. So I'm going to show you two different types of annuities. The first one is a FIA, or a Fixed Indexed Annuity, and the other one is a MYGA, which stands for Multi-Year Guaranteed Annuity Contracts. Those are the fixed rates. They're like CDs, and they're paying out a lot right now. But the FIAs do well as well, but you have to pick the right one with the right company, okay? So you might hear people that have horror stories with some indexed annuities, and they really do happen because advisors don't know what they're doing, and they'll put them in products with the wrong indexes and the wrong companies. And it doesn't work out for the client. They don't have the growth that they were projecting because the indexes are just new indexes. They're not tried and true. And the companies, a lot of times with the tried and true ones like S&P 500 or NASDAQ, will lower the participation rates quite a bit after the first initial term. So if you're looking for the best growth and you're looking for the best security, then I would recommend working with someone like myself who lives and breathes annuities every day. Okay, you can work with an advisor and they will give you access to a few, but most of the time, the ones that manage money, they don't have access to a lot. And if they do, they don't know very much about them because there's just a lot to know. So anyways, I'm not going to try to toot my own horn, or I'm not going to try to, pressure you to work with me. I don't care. I'd rather you just find out, research these for yourself, and then if you're comfortable, reach out. So there is a link below my video. If you want to book a call with me, feel free to do so. Otherwise, go to my website, check out annuities. You can see MYGAs actually on there, but you won't be able to see the fixed index annuities because they change all the time. There's so much to know on those. If you're looking for one of those for a growth product, then absolutely book a call on my website as well. It's johnstevenson.com. All right, so I'm going to share my computer screen because I want you to see what I'm looking at, and I want you to see how these can grow for you. They all protect your money against market risk, okay? That's a given. Okay, if you wanted a variable annuity, then go to a securities advisor for that, okay? I work with the guaranteed side, all right? Looking at my screen, I pulled up, and let me just go back to my other window here. So I pulled up a specific company, Lincoln Financial. So Lincoln Financial is a specific company that I like because of their renewal rates on their participation rates. What does that mean? Well, participation means how much they let you participate in the index. So if you are only allowed 50% of the index, well, if the index does 10, what are you going to get? You're going to get 5, right? It's that simple. Okay, if they give you a cap of 10, then they're going to cap your earnings at 10. Even if the index does 11 or 12 or 15, they're going to cap it at 10. Okay. So the reason why I pulled up Lincoln, because they are one of a few companies that I like. Delaware is another one. Global Atlantic is another one. National Life Group is another one. They are known to keep their renewal rates very constant with these indexes. And the indexes I'm going to be focusing on is the S&P 500. You've got a lot of indexes. And if you look at my screen, see all these different ones. See, NASDAQ's not bad. The S&P, okay. But I can pull up a screen and look at some other companies, and you'll see a lot more indexes that you've never heard of. Barclays, Fidelity Multi-Factor. I mean, they have familiar names, but they're completely brand new, okay. And a lot of them are not tried and tested, okay. Another one is Pacesetter. Okay, it's a U.S. pace setter that National Life Group uses. It's not bad, but it hasn't had great returns over the last 5 years. So you just do better in the S&P 500. So anyways, there's different variations of the S&P 500, but I'm going to go and I'm going to show you the best one that I would recommend. And this is for the state. Let me see here. The state of Colorado, the participation rate is 60%. And I just threw $1 million in here. So I know this is probably higher than you might want to put in here, but this just for an example shows you what this will do. Okay. So $1 million, if the index does nothing, well, the account value is not going to do anything. It is kind of nice that the death benefit goes up. So that's kind of nice. So, if something doesn't happen, they kind of reward you with some extra dough in there. Okay. But let's go to what probably is going to happen. It's probably going to grow, and it's probably going to double, more than double, to probably 2.3 million over 10 years because they're giving you 60% of the index. They're not giving you 100%. You might be thinking, well, that is not right. They're not being very generous. They're being kind of greedy. Well, they got to make money, but they're not being completely greedy. They're spending billions of dollars on on call options. Okay, call options are expensive with the S&P 500. And there are times where they cannot exercise these call options at all. What happens? Well, they lose that premium. What happens to you? Well, you don't lose anything. Okay, you didn't have to buy those call options. Okay, so what happens is you don't make any money during that time period, and neither do they. In fact, they lose because they still spent money on the premium. Okay, so during the good times, when the market is doing well, when the index is doing well, when they do make money, they're going to pocket some of that money to compensate for the how much they had to spend for their premiums, but also make a profit. But then they still give you 60%. Okay, so there is a cost of protecting your money against market risk, and this is a cost. The cost is they're going to give you 60%. Okay, instead of all of it, and that's how they do it. And so if you allow this to sit and grow, you're going to have years where it doesn't make anything. You can see the zeros in here. This is just showing the last 10 years, and then you got years where it makes a lot. Okay. And yeah, you're not going to make as much as the stock market, but you're watching this video because you want security, you want protection, but you also want growth. So I'm trying to show you the best product that I would recommend for highest growth and also 100% protection against market loss. All right, so I can kind of go further in this, but I just kind of want to show you how this works with one particular product that I sell and that I recommend out of thousands. Okay. All right, now I'm going to go over to another one. Let me just pull up Delaware Life. See a 10% cap? Oh, sorry, 10%, 7% cap, 10% premium bonus. You can do premium bonus, but I wouldn't recommend it. So let's go up a little bit higher. Premium bonus just means they're going to throttle your earnings later on. So see, look, they give you the same 60% participation rate. So I'm not going to pull this up because the numbers are exactly the same. So they give you different options: 10 years, 7 year, and a 5 year. If you do smaller surrender charge periods, where your money's locked up less amount of time, they just don't give you as much. Okay. But if you have this as a long-term instrument, I would just do the 10 year, but that's up to you. So, and then we go down, they give you some different variations, and they got account fees, and these are the completely different indexes. Actually, no, it's the S&P 500, but they do an enhanced participation rate. That's what they're doing. All right. Cap. That's what I want to show you is a cap of 10.3. Let's look at that. So Delaware, they'll probably keep that cap pretty constant. Okay. But remember, when you've got years that the index says 20%, you're still getting 10. Okay. So, but that's the cost of protection. But if you look at this, over 10 years, it grows to like 1.972. Still pretty good, but not as good as the participation rate. See the participation rate? Way better. It's like 350 grand more. Okay. I like participation rates more. That's just my personal opinion is participations are better because when you can participate in a portion of the index and not be capped, you tend to do better long-term. So that's what I usually recommend for long-term strategies. Okay. All right. So having said that, we're going to kind of go off of we're going to leave the FIAs for now, the fixed index annuities. They protect your money against market risks. So now you know how that works. And they also give you a portion of it. So it's a great growth strategy that gives you security, gives you protection, it gives you growth. And if you want to start taking income off of these, you can. It's not guaranteed income streams. If you want guaranteed lifetime income, look at my income writer calculator on my website. Go to johnstevenson.com and you can look at that. But if you're looking for just growth and you just want to strip off some of the interest, some of the earnings as time goes on, these are great products, but you just have to realize they're hypothetical because we don't know what the indexes are going to do. All right. So let's go now. I want to show you the MYGAs. And I'm going to show you the top ones. There's hundreds of them. Okay. So if you want to look at my website, go to the MYGA calculator and you'll see all of them for each term. All right. This is just showing the top 3 and I didn't put any filter in here. So regardless of what the rating is or what, if they allow you to take withdrawals or not, it just shows you everything. So if I go up to 10 years, the highest is 6%. Okay. That's pretty nice. Total earnings is 790 grand. So they don't allow any withdrawals though. So that's the cost for this one. So the MYGA is just really, really cut and dry. If you look at these, it's 60 grand a year. And then it compounds. You can see over time it compounds and the last payment's like 100 grand. Okay. So it's 1.79. That's your ending balance. Very simple. Okay. If you take money out, you're going to be subject to that surrender charge. So let's say in 5 years, you're like, I want to cancel. I'm done. Okay. Well, you're only going to get 1.271 instead of 1.338. Okay. That's the difference. Okay. Now when you're looking at MYGAs, okay, you don't have to get ones that don't allow any withdrawals. You can get ones that allow interest only or up to 10%. So with the Revol one, they give you 5.9. You're pretty close. And you can see interest only. Yeah, you can do that. If you want to live off the interest, go ahead. So protect your money, live off the interest. You get 59 grand a year. Okay. At the end of 10 years, you get your $1 million back. Pretty simple. Okay. So you can do that. You can also do something other than a 10. Let's say you did a 9 or an 8. If you're looking for highest rates, though, I tend to find the highest rates in the 10-year options, the 7-year options. You can see 7 years like 5.85 or 5.75 for interest only, and the 5-year. The 5 years typically are very competitive. So again, we're at like 5.85 or 5.8, and this one with Exonic is giving you 10% free withdrawals after the first year. When you see interest only or free withdrawals at 10%, it's saying you can take up to that amount without having a surrender charge levied. Okay, that's what it is. So if you take out more than that, then you're subject to whatever the surrender charge is. So, and you can see there's other ones. There's 4, there's 3. But if you're going to do it for such a small period, you might want to just leave it where it is. Leave it in the money market rates, or high yield savings. But that's up to you. Anyways, you can go to my website and you'll see all these rates. But the reason why I wanted to create this video is just so you can see the possibilities for growth. Okay, you've got guaranteed growth on the MYGA side, and you've got hypothetical potential growth on the index side. I love the index side because typically you're going to do better, especially long term. But MYGAs are a great place to park your money if you don't want to put it into a CD. So both options are great, and I sell both of them all the time. So anyways, hope this helps. If you have questions and if you want to purchase an annuity, then please book a call with me. There is a link below this video, and there is a link on my website, johnstevenson.com. So I'm happy to help, and I do appreciate you watching these videos. I do try to be as transparent as I can. I try not to be salesy. I hate sales guys, but I do want to show you, here's what's available. If you want growth, here's what's available. This is the best one that I would recommend. If you want guaranteed, here's what's available for that. If you want highest lifetime income, choose the income rider or do the SPIA or DIA. It does not matter to me, but what does matter to me is that you are seeing all options, okay? And you can do that on my website, johnstevenson.com. And then when you're comfortable, reach out to me. So anyways, won't try to hard sell you, pressure you, or anything like that. I hate those sales tactics. So I'll be there to help you if you decide you want to buy an annuity. So hope that helps. If you like the video, subscribe, share, like the video, comment below if you got questions, and we'll see you next time.